Everyone is so quick to talk about the asset, whether it's the syndication, the deal in front of them, the private equity opportunity, and so on. And while the actual investment obviously matters, I have found that the person behind the deal, the team behind the deal, matter just as much, if not more. And I'm going to give you a couple of examples in my own life where I've seen that come into fruition in multiple ways. One time I had an investment opportunity, and on paper, the deal looked fantastic. They were buying the opportunity at a great discount. They were going to be able to force appreciation. All of these things looked good. But the problem was they've never done it before, and they're a first-time investor. So what I have found through experiences like that is a really good opportunity with a bad operator can still go bad. And a really bad opportunity with a bad operator goes even worse. But on the flip side of that, a really bad opportunity, but with a good operator, I found good operators, they oftentimes find ways to make even a bad deal better. And even if it's not like, an A+ home run type of situation, they make lemonade out of lemons. And I think that's a really important factor in dealing with the operator and who you're investing with and what they are doing. So that's something I look at quite frequently within my lending company, 42 Solutions. It's like, man, I want to deal with people with good credit scores, not because they have to have a good credit score and things happen. I understand. So there's flexibility within that. But at the end of the day, somebody with a good credit score is a good sign that they are responsible with their finances and they know how to manage it. I like to have operators who have done it before. So they have a track record of success, but also a failure. How did they navigate during tough periods? So if it's somebody who's been investing for 20 plus years and they went through the 2008, 2009 crisis, I'm looking at that. Well, how did you navigate that time period? How did you navigate COVID? There was a lot of issues with COVID and people were having problems within their business and their investments then. So I like to see that, how they respond during certain time periods. And I think that is a really important aspect. So there's so many people out there being in the lending business. I see some people who will say that they just lend based on the asset. And I understand it. And that is your safe gate no matter what, because if the borrower messes up, and sometimes even good borrowers can do that, then at least you know the asset is good. I have personally found that they go in tandem, and I don't like to give out loans. I don't like investing with or investing in anyone who I do not believe is a good person, has a good, spectrum of like belief systems and what they do, how they operate, how they communicate, how they interact with other investors, borrowers, their reputation they've built. Are they of good integrity? How are they going to handle chaos when problems hit? Because in most times and in most businesses, problems are going to arise. So I want to work with operators, investors, business owners who know how to navigate and who are able to problem solve. So I'm looking at all of that, and I think that is oftentimes just as important as the deal. So I don't really want to pick one or the other, the deal or the borrower or investor. I want to pick the deal and the borrower and investor, and I want to find opportunities where I can marry up a good opportunity and a good operator, good investor, good business owner, good borrower, what have you. So I wanted to kind of really shine light on that, because so many people will talk about how the deal's all that matters. But if it's a good deal and you're dealing with chaos because you chose a bad operator, I'd rather avoid that situation altogether. So I really challenge you to try to marry the combination of good operators and good opportunities and good deals. And that's what I try to do within 42 Solutions. So things I'm looking at is, do they communicate well? Do they have good credit? That's a good place to start. Do they, background searches? Have they had any major issues? What's their reputation? So I'm lending primarily in Arizona. Have they screwed a lot of people over? Do they have a bad reputation? What's their track record? Have they dealt with projects of this size, of this magnitude before? Have they dealt with the same asset class? Sometimes they're switching asset classes. So these are all the things that I'm looking at. And I think that should be the case no matter what you're looking to invest in. So if you're looking at investing in a startup company, obviously the opportunity needs to be right, but also the people who are behind it, who are going to be making it work and making it churn. So I think that's a really important aspect. Do not forget the people, because at the end of the day, business, and specifically real estate, is a people business first. And there are people, so that's why you see really good operators and really good investors make great opportunities out of bad deals, and you see really bad operators make a great great deal and turn it sour. So be careful in that. Really kind of pay attention as you're investing and as you're looking to grow your investment portfolio, as you're looking to start and grow businesses, as you're looking to lend, maybe you're lending like me, make sure you're marrying up the operator and the opportunity, because that's the best way to go. I hope this video was meaningful for you. Make sure you check out the Capital Edge newsletter, where I really dive into topics like this as well in written form. And I'm going to continue to deliver value that I'm seeing in real time while I'm growing my businesses inside of 42 Solutions. So check out the Capital Edge, obviously YouTube, make sure you subscribe, but also check out the newsletter and hit the link in the bios. Appreciate you guys. Number one is that private lending gives you control and predictability. So you get to determine the LTV that you will lend at, the types of deals that you will fund. I think that's really important because I'm able to respond to the market in real time. If I'm feeling a little scared about things, I'm going to do a loan with a lower LTV. If it's a really good operator and they have a ton of cash and good credit and all that, maybe I'll go a little bit higher. But if we go into war or things are happening, the presidency, the tariffs, all these different things, I can move and scale in real time within the lending and still get high double-digit returns on my capital. So that's something that I appreciate. I have control and I have flexibility. Now, that's something that stocks, that's something that equity positions don't always provide you, even within real estate. You might be stuck more or less, and that's what's happening a lot in commercial real estate right now. Interest rates run up, they're way higher, way longer than they anticipated, and they're stuck in deals, and they're having to refinance or turn in the keys, and it becomes extremely problematic for a lot of people. So that's one great reason why I think private credit is a stronger position right now than equity. Another one is the macro environment is pushing capital to private credit. So what I mean by that is equity is getting riskier. There's a lot of risk inside of equity today. So you got to be mindful and careful of that and saying, okay, like if things are a little more volatile, if interest rates are up, if all this is going on, do I want to take this risk for this return? Is the return high enough to justify the risk? And a lot of people are saying no to that. So that's why you're seeing a lot more wealthy individuals and hedge funds and private institutions that are putting more money into private credit right now. So the last thing is distress equals opportunity for strategic lenders. So now you're dealing with all this distress in the single family market and multifamily, all kinds of commercial within businesses. So with that, they need an infusion of capital. So for strategic lenders who can control and dictate their own terms, they are able to be in a power position to provide loans to businesses, to real estate investors, whether it's single family or commercial in some kind, and they get to set the terms based on their risk profile and what they believe is a good loan to provide. So that puts you in a really strong position because you can take advantage of the distressed situation by being the bank, essentially, for these businesses, for this real estate. So I think those are the three reasons why more and more people need to be looking at private credit for a vehicle in 2025 and beyond. And not to mention just the cash flow. So while all this movement is happening, having a place to place money where you're getting consistent income is a very strong place to be. So that's why I'm putting my money in there. I'm not telling you that you have to, but I believe it is a very powerful place to put your money. And I see that many high wealth individuals are doing the same. So I wanted to share what I'm doing, why I'm reallocating some of my real estate into private credit, and why I think you should too. But that's just my 2 cents. Do what you feel like is best for you.